Thank you and good morning. I'd like to extend my thanks to VCCircle for inviting me to participate and moderate this morning. I'd also like to welcome our august and very brightly lit panel. We'll see. We'll all have a good tan, I think, by the end of the 45 minutes up here. I thought we'd just kick things off with a question and then really throw it open so that the panel can respond to the questions that you all have. But I guess the most basic and fundamental question that sort of on everyone's mind is India a good investment? And what do you guys think about it? Jürgen, shall we start down at your end?
Yeah, thank you. I'm probably a little bit the odd guy here on the panel, maybe even in the room, because I'm the chief risk guy of FMO. And actually the main reason why I'm here in Mumbai is not speaking on this panel, but actually with my colleague who is sitting over there. We're actually visiting some of our clients, but not some of our well-performing clients, actually some of our not so well-performing clients. And we have an above average percentage of NPLs here in India. So to be honest, and I guess we have to be honest here on this panel, we haven't been as excited about India as possibly many of you. Particularly in the sectors we do not know very well. We focus ourselves on financial institutions and the energy sector, by the way, both quite regulated. In all the other sectors, we're actually struggling. And we're struggling because of many reasons. Some of the investments we have made, they're probably in companies which we didn't know too well. Transparency was not too good. Then if you try to go to court, well, not even, don't try. I think the legal system has been quite, let's call it ineffective here. So our returns have been relatively dismal. So I'm looking forward to some of the questions from the audience later on that one.
Lucian?
Sure, I'm happy to share my thoughts. I think the audience would be slightly pleased to hear that I have more of a positive perspective for the market following that introduction by Jürgen, I suppose. But just to get kind of by way of background, when I started started my private equity career in Asia, that was back in '95. So I had the fortune of actually starting with the Indian market. So over the years, we've invested in, when I was in Henderson, when I was in Jardine Fleming, we invested in a lot of IT companies, Complete Business Solutions Inc., for example, and telecom companies. We were early investors in Bharti Airtel, for example, and then we also did a number of investments in the media sector, including Hindustan Times. So we've done reasonably well in terms of investments in the private equity space here. So, but I mean, that being said, I think India, it's a difficult market for foreign investors, for domestic investors, especially in the private equity side. I think the key is you really have to choose the right managers. You have to choose the right sectors. The way I look at it now, the new economy is interesting. The consumer sector is interesting. I've never been a fan of infrastructure, for example, and I guess I've turned out to be right. But over the years, when I started in '95, I've seen a lot of progress here. The airports are different. The roads to the airports actually work now. So I'm encouraged on a number of fronts. I'll just kind of take a pause there.
Great. Simon?
I look at India from the perspective of Singapore, where I'm based. I guess if you ask most of the GPs in this room where their capital has come from, they would be looking very much to the United States and Western Europe. Singapore itself has become a very important font of capital and interest in this continent. And I think where the question marks reside, which I hope we're going to tackle today, are what is the best way to tackle India? Should one be going through the established private equity groups? Have they done a good job over the course of the last decade? Have they done a good job relative to public equities? We run a joint venture with UTI out of our Singapore-based business. It actually happens to be a regulated Irish UCITS platform. It's a public equity market vehicle. It's by far the best performing fund of any of the emerging markets funds since we launched that in 2012 and has delivered returns in the order of 25%. So the public equity markets have potentially outstripped opportunity in the private markets, which I think have been very, very challenging. That is why I think there is this big shift now away from investing into the established private equity industry, the GP LP model, into far more private transactions, direct investments, notwithstanding the non-performing loans, the position of the banks, which are overburdened with non-performing loans. There are opportunities also in the debt markets to intermediate between where the banks perhaps were once upon a time and the needs of Indian companies. So we're finding that there is a lot of opportunity and interest, particularly from Southeast Asia into the Indian subcontinent. And perhaps on that note, I'll hand back over to Gordon.
Hey, thanks. Before I throw it open to the floor, just one more slightly more granular question, but as we see the dynamics shifting between LPs and GPs, how do you see the risks and rewards of that moving both for LPs, for PE firms, and also for companies seeking investment? Simon, would you like to get us started?
Well, I think that
Do you think India is a more risky place for someone, for an LP to be making direct investments?
Clearly India does present risks, both risks of a logistical nature, risks in terms of the currency, which, of course, if you were on the wrong side of the rupee over the course of the last 2.5 years, or indeed over the last 5 years, you would have lost an enormous amount of money in rupee terms investing in US dollar terms, investing in India. So I think there are undoubtedly very significant risks, and that is why investors are looking to disintermediate some of the fees that the industry, the private equity industry, extracts. The co-investment model, we had a discussion prior to this session, and I was very interested to hear from Jürgen about what is becoming increasingly typical. Large LPs will only invest now if they can have significant co-investment rights so that they can circumvent the costs of the infrastructure of private equity and the embedded costs within those organizations, and indeed the high-profile 2 and 20 type fee models that they have traditionally extracted. We're in a worldwide environment where post the global financial crisis, 67% of private equity businesses have not been able to raise any money. They've not been able to raise a new fund. And so we're still waiting to see the outcomes of those tremendous vintages of the pre-financial crisis, which may well be disappointing. I don't know what the statistics are going to be like here in India, but from what I'm hearing anecdotally, there is considerable disappointment. It doesn't mean that India is not a place to invest. It's more a question of whether the old model is the appropriate way to invest. There are, the corollary, I guess, to that is that the argument of the private equity industry is that one needs private equity professionals and the expertise that they have in both the stewardship of money and management of businesses to serve as the intermediator between LP capital and the ultimate investment objective. And that is a good argument if they deliver the returns.
Sir.
Yeah, maybe to add to that, Simon, indeed I mentioned in our pre-discussion that what we're trying to do is we don't have any presence here in India. And I think to be successful, certainly when making equity investments into small and medium-sized companies, you need to be on the ground. You need to once in a while kick the tires, and once in a while, probably is every few weeks or so. We cannot do that ourselves, so we still need you guys. But indeed, increasingly, we would like to have either right of first refusal or whatever it is on the co-investment side. Because co-investing alongside you means that you can be our eyes and ears. And one of the other reasons why we like that is historically in our worldwide portfolio, and we have roughly 1.5 billion euros invested in related to equity. Direct investments, the returns are significantly higher than the net returns from private equity funds. So this is one of the other reasons.
Lucian, what do you think of the co-investment model?
Before that, to Gordon's first question, is India a riskier market? I just give a quick response to that. In terms of our portfolio, we have $12 billion under management. Half of that is in private equity, half in real estate globally. So in terms of our exposure to India, within the Asian exposure, we have about just a touch over 20% to India. So that's not a small percentage allocated to India. So if the question is, have we made money in India with certain managers? The answer is definitely yes. But as a whole, has the private equity market in India performed in terms of track record? Has it returned cash and distributions to investors enough? The answer would be no. So to me, you really have to be very careful about how you choose your managers here. If one is to benchmark kind of India and China, I guess there's still quite a gap in terms of the size of the market, the number of exits that have come through, the number of managers that kind of can demonstrate a consistent record, a track record of making money and generating returns for investors. So that's one challenge. But to your question of co-investments, I think the broader topic here to me is about disintermediation in the entire private equity industry. It's not just happening at the GP level. I think it's happening at all levels, all the way from the ultimate LPs, the pension funds, the endowments, to the fund of funds, to the GPs that I assume a number of you are. I think the question being asked is, what is the value you're adding? Can I do it myself? The one big reason why investors like Jürgen is looking for co-investments is to me would be to look at a kind of on a blended basis, a lower fee when they make commitments to funds. How do I actually kind of minimize my fees and carry to that commitment? So and there's fee pressure everywhere. Ultimately investors are asking, this asset class as a whole. I think, to me, and if you look at the stats, it has proven itself that it has outperformed publics for the last 10 years. But the question is, I think it's getting more competitive. There are more GPs in the market globally, not just Asia. There are more players in the market. How do you remain relevant? When you go out and raise your next fund, how are you differentiated? How are you different? So that's kind of my thoughts on the co-investments, as well as your first question, how risky is India?
And Lucian, just one follow-up for you. You were saying that India has underperformed so much. What do you see as the main reasons for that, for the underperformance?
I think probably, to me, India is a market that, for example, on the private equity side, a lot of times you're actually competing with public capital, because relative to the other Asian markets, for example, if you take China, for example, getting a company listed here is not that difficult. It's not going to take that long a time for you to list a company, and with the 5,000 plus companies listed on the stock exchanges here, a lot of listed companies here. So when you are looking for good deals, interesting deals, you could be competing with public capital. And I think a corollary of that is that entry valuation here tends to be high compared to other Asian markets. That's a function of a number of reasons. And I think so far, in some ways, the market has gone through a number of kind of negative macro headwinds in the last few years. To be honest, I think 2-3 years ago, India was not such an attractive market for global investors to think of an allocation. I guess to put it bluntly, is India a market that a global investor must have in the portfolio? The answer may be not exactly. Is China a market that people need to think about putting some money to work in a global private equity portfolio that has an emerging market element to it? The answer may be yes. So that's the difference. And I think to generate more global kind of interest in the market, I think we have to see more exits coming out from this market, which we haven't seen enough. That's my sense of it.
Thank
I
you.
would like to
Jürgen,
add to
please.
that. Is India a market for development finance institution to be in? The answer is absolutely yes.
Thank you. I'd like to thank Simon, Lucian, and Jürgen for sharing their thoughts with us today, and really appreciate you all having us here. Thank you.